What's up, guys? It's your boy Khaled. Okay, so I've been getting a lot of questions about options trading, how to trade options, what's a strike price, what's a call, what's a put, blah blah blah, decay. So look, I'm going to dumb it down as much as possible and make it as simple as I can to understand. Even for myself, it took me forever to understand options, and to be honest, now that I understand it, I don't know why it took me so long to understand it. So I'm gonna break it down as simply as I can so you guys can catch on quick. All right. Uh, as always, if you guys haven't, go ahead and hit that like button if you find anything good from the content. If you haven't subscribed, go ahead and hit that subscribe button. Turn on the bell so you know every time I put on a video. Could be a short one. I do a lot of the shorts. It's just easier to get the information out there. It's really quick. So if you've been following along on that, then you must be really, really happy with Tesla right now. All right. So anyways, yeah, let's get right into it. Okay, so obviously I'm using Thinkorswim platform for my trading. You don't necessarily have to use this one. A lot of people use Interactive Brokers, IB, whatever is your choice. It should be the same format for all of them for the most part. All right, so we're using Tesla simply because this is something I trade on a daily basis. Now, when you're looking at your chart, you want to go into the trade grid. It's going to pop up a whole bunch of stuff, which is just going to probably throw you off completely. What you need to look at is expiration, okay? The closer the time is to the expiration, meaning you have different dates here, right? You've got 28th of May, which is Friday. So this is going to be for next Friday, since yesterday was the end of the last contract. All of these go based off of contracts. They're weekly contracts. So you could do weekly, you could do 2 weeks out, you could do a month out, a year out, if you want to do leap option calls, which are just very, very long durations. But I'm going to explain the difference between all of them. So just to, but we'll take it all in steps. Okay, so first, let's look at the May 28th option calls. All right, now when you're looking at the options, you're going to see two different things. Let's make this a little easier. This might be too many. So here we go. We'll just go with 10 different strike prices. All right, you guys can adjust it to see as many strike prices as you guys want to see. I usually have it set to all, but we'll just do this for the video, make it 10. All right, so now you're gonna see purple and black. Basically, you've got in the money and out of the money. And I'll explain exactly how that works. All right, so you've got, same as whenever you're buying and selling stocks, you've got a bid price and an ask price, right? So buy and a sell. Now, whenever you're gonna be buying something, you are gonna go for the ask price. Now, the difference between in the money and out of the money calls, all right, and of course you've got calls on your left side, you've got puts on the other side. You want to use the calls when you are trying to buy something because you believe it's going to go up in value, and you want to use puts if you believe it's going to go down in value. Okay, for myself, I usually never short or I never use puts. I'm always using calls if I'm using options. All right, so when it comes down to in the money and out of the money calls, in the money means, for example, Tesla, since we're using it, the price closed at 580.88. So let's just say hypothetically that the market is open right now. Now, if I want to buy an in the money call, it means I'm going to stay with the purple because it's less than its current value. So if you buy it, you're already in the money. All right, and now these prices are usually going to be higher. The further you go out of the money, the cheaper the stock is going to be, because it's not a guarantee that the price is actually going to hit that target, right? So, and the price being the strike price. Now, the strike price means if you think that it's going to go from 580 to 582.50 or 585 or 590, then you've got these prices right here. Right, you've got 580, you've got 582.50, you've got 585, 587, 590. These are all out of the money because it hasn't reached those values yet. So the closer that you get to in the money, the higher the price is going to be for the bid and the ask. Now you're probably thinking, well, this thing is 577.50, but this is 1855. So why would anybody want to buy a stock for 577 when they can just buy it for 1855? Good question. The difference is if you're buying Tesla at 577.50 from just a stock point of view, just buying the actual shares itself, then yeah, you buy one share, it's going to cost you $577.50. If you buy 10 shares, it's going to cost you $5,775. If you buy 100 shares, it's going to cost you 50,700, or no wait, I'm sorry, 57,000 or 50,000 something?
1 billion, gajillion, fifillion, million.
I don't know, my math sucks. How the hell am I a trader? But either way, you get the point, right? It's going to be so expensive if you're doing that. Now, when you're buying options, you're buying a contract, all right? So each option consists of 100 shares, right? And they're called lots. So one lot is the equivalent of 100 shares, all right? So a 577 option call, one lot would be 1855. Now you got to multiply that by 100. So this is really going to cost you $1,800. It's not going to cost you $18. It's not going to cost you $180. It's going to cost you $1,800 to buy one options contract, which consists of 100 shares at the ask price of $18.55. So when you click on something like this, okay, so this was a different one that I was trading, but if we click on this one, right away you'll see that it goes to 10. So that's usually the amount of options. It just keeps as a standard, we'll just say. You don't necessarily have to buy 10 lots of these. That's just insane. You could buy as many as you want, or you can even sell them. But we're just going to keep it simple today and just talk about buying calls. All right, so if you're going to buy one lot, all right, one option call at 577.50 strike price, which is still in the money, it's going to be 1855. Now you can't trade this after hours or pre-market. This has to be during market hours for options only. So if you want to hold it overnight, you can, but just make sure you have good reason to believe that the stock is going to move in your favor the next day during market hours. All right. Now, before we get into buying even more, I mean, we already talked about the simple stuff, you know, buying 1, 2, 3, 4, 5, 10, however many you want to buy. Right. Now, if you go into a different date, right, and we're going to look at the same price. Let's go to June 4th. Now, June 4th, 577 in the money jumps up, all right? It jumps up $6. What happens if we go further out? Let's go to June 11th, 577. Now it's 30.60. So you see, the further out you're going, the more it's going to cost you, all right? And the reason why is because you're paying for time, all right? That's why there's time decay. So when you're buying something that's going to be expiring, say a week out, it's not going to cost you that much because there's more risk. You don't know if the stock is going to get to a certain price before your time of expiration. So the way that options contracts work is they get cheaper, or like they lose value the further the time decays. All right. So if you're buying something that's just out of the money, like for myself, I'm always buying this one, the one that's just out of the money. All right, because I'm pretty sure, like, I have a higher rate of conviction that it will reach this price before the time of expiration. And to be honest, I option trade the way that I day trade with just regular shares. I don't hold an options call for the entire week or 2 weeks or 3 weeks. I don't swing trade it. I day trade it. Sometimes I'll swing it like overnight, like I'll buy it just before market close if I believe the stock is going to continue to push up. And then at market open, I can sell it right away. And you make pretty good profit, right? Depending on the amount of lots or options that you take. So back to time decay. Now, if you're holding a stock and it's just going sideways, you do not want to do options trading on a stock that moves very slowly. All right, because you're paying you're paying a premium for it when you're buying these shares or when you're buying these options. If you buy this at 18.55 for 577.50, and you know what, let's just make it simple. If you buy one lot 17.15, so you're getting 100 shares at 17.15, all right, for the 580 strike price. Now let's just say it's at 588 or 580 and 88 cents. Now it's in the money, but it's not going anywhere. It goes up to 581, it comes back down to 580, goes back up to 581, maybe even 580, 150, comes back down to 580, 579.50. You're thinking, you know what, that much fluctuation, it's not a big deal. But it is when it comes to options, because you're losing money on the time that you're actually losing because it's coming closer to your date of expiration. So you can end up walking away with a lot less money if you're holding on to a stock that is really not moving. It's good for a company it also depends on how your style is. So if you're trying to do a day trade or if you're trying to do a swing trade, you want to do the same thing as you do with the stocks. What I normally do is I'll purchase, let's just say if I'm getting this, we're gonna, just for the fun of it, all right, we're gonna buy this, and then instead of just holding it, I'm going to set it for a sell price, all right? So I want to sell it. If it's $18.55 I buy it for, I want to sell this at $25, right? Doesn't necessarily mean it's going to go up to $25, but at least it starts moving in towards my direction. And once it gets close enough to a rate or an amount that I'm comfortable with, I can cash out. I can go ahead and sell it. I can close the option, or I can roll it over, meaning, you know, somebody else can take over. Or if I want to buy the stock at the 580 strike price, that means that I can own the stock even though it goes up to 588. It goes up to 590. It doesn't matter. My options were set for 580. So now that it reaches this price and I'm thinking to myself, you know what, should I sell it or do I want to keep it? Do I want to own shares of Tesla? Then I can say, hey, you know what, I want to keep it. Then I can roll it and I can keep those shares. Whoever it is that sells it to me has to give it up at the price that I purchased it at prior. So the way that I do my options trading with the calls is very simple. I look at a stock, I see where it's going. I'm still using resistance levels, I'm still using support, I'm still using the EMAs, I'm still looking at everything in the chart to see if it's going to be working in my favor. And with Tesla, I've seen ever since it hit its highs of 900, it's always getting rejected at the 200-day moving average. It's time and time again. Like from here on, I think this was the first time it got rejected, right? Back in April 30th, okay? So April 30th, it got rejected. May 3rd, rejected. May 6th, rejected. May 7th, rejected. And it just keeps on going down. There are times where it makes a run back up, but as you see here, I have all my purples. I have all my gaps mapped out. So I know that if it's up, it's gonna come back down to fill a gap. Or if it goes down and gaps up, I know it's gonna come back to fill the gap, which is exactly what happened here. It came back, partially filled the gap, but it didn't completely fill the gap, and then it pushed all the way back down. It didn't quite hit my level of support, but it came close enough and started making a reversal. So what did I know was gonna happen? I knew that it's gonna go back up to fill the gap. It did have a little bit of resistance here at this level of resistance, broke through it, got the next level of resistance, came back below both, and then broke above. As soon as it filled up the gap on Friday pre-market, it's a perfect sign that one, it already filled the gap. Two, it's got the 200-day moving average right above it, which on the 20-day chart has proven time and time again that it does not have the strength to push through. So you take out a short position. So I couldn't do any calls on Friday. I was not trying to do any options trading on Friday, just because I didn't have a lot of belief that it is going to push through. And of course, there's been a lot of negative press on Elon and with Dogecoin and Bitcoin and China. So there's a lot of reasons to not go long on it right now. And even though my pattern is in play with the 200 below the 50, I'm sorry, with the 20 below the 50 below the 200. But as you can see here, rejected by the 200, so you just shorted. But either way, when it comes down to actually options trading something, make sure you always do your due diligence. I know that with Thinkorswim platform, you have to have a minimum holding, or you have to have a minimum account size of 25K US in the account for you to actually trade options. So you, based on your account size, you may or may not be able to do it with Thinkorswim. There's other platforms like Interactive Brokers where you can options trade with a minimum balance of $2,000. So you can use that one for your options trading. I know that the platform on desktop is not the easiest, it's not very user friendly, but their mobile app is super easy to use. So you can try that out, but definitely be careful and just keep that in mind. When you are buying something, you want to look at the expiration date, because of time decay, it is going to eat up the, it's going to eat away at your profit or the ask price. Like the value is just going to keep on depreciating the longer you are holding something. So try not to, if you are looking to swing something, don't get something that's going to be expiring on the Friday or the week of. Try to get something that's 2 weeks out, 3 weeks out. It gives you a little bit more time. It does cost a little bit more money every time that you go further and further away, like with your expirations. And you don't want to go too far out of the money. It does cost much less. So if you look at the strike price, if we'll just put all, you get a lot more to play with. But the further out you go, do you really think that it's going to be going up to 660? And do you think that it's going to get to 660 by the 28th of May? It's highly unlikely that's going to happen. So there's no sense of you trying to trade that just because it's cheap. The fact that it costs so little and it's so far out means that the amount that is going to move is going to be insignificant, and you are not going to see anything anytime soon. So each brokerage is going to charge you guys different rates. Now I know Thinkorswim, we all know Thinkorswim is a little bit more expensive. For options trading, buying a contract is $8, but I'm sorry, buying and selling of your options is $8, but each contract is $1.25, buying and selling. So if you buy one lot, you're really paying $8 to buy it plus $1.25 for that one lot. And then when you're selling it or closing it, again, $8 plus $1.25. So each transaction, each complete transaction is going to cost you $16, $17, $18, $50. All right, so $18, $50 just for one contract. And keep that in mind, because a lot of times you may end up buying more. You may buy 4 contracts, 10 contracts. With OCGN, I bought 400 contracts. So you want to make sure that you keep that in mind, because you don't want to end up just making so much money, but then when you're closing out your options position, you don't make enough to cover the fees that were involved for your options. Now, obviously, like I mentioned, Interactive Brokers, they are much cheaper. So your options might only cost you about 80 cents or 50 cents. So just keep that in mind when you are buying and selling or trading options. All right, I'm gonna get back to this Nutella and you guys can get back to the video. Oh, and if you guys are curious about my sound, it's pretty clear. It's because of this Rode mic. Yeah, these things are phenomenal. See? And I got a little rat on it. And this thing, like, it gets rid of all the background noise. So keep something like this in mind too. It comes in pretty useful. And I'm not even wearing it. It's sitting in, like, by my laptop. But the sound is actually it's catching the sound pretty well. All right, back to the video. Back to my Nutella. All right, so if you gain anything out of this video, please let me know. Go ahead and give me a like. If you have any questions or any comments, you can go ahead and leave some comments down there. If you're new, subscribe, join the team. All right, stay green, guys. Do your due diligence, trade safe, and I'll see you guys in the next one.